What if I told you that one of the most powerful tax strategies available to business owners involves hiring your own children? This is completely legal, it is IRS approved, and it is one of the most overlooked tools in the Family Wealth Playbook. If you have kids and you own a business, stay with me because this one is worth your full attention. I'm Sonya Moreno, tax strategist and founder of Sonya Moreno CPA LLC. I specialize in helping business owners build wealth strategically. Hiring your children is one of those strategies I walk clients through because it accomplishes multiple goals at once. It reduces your taxable income, it shifts income to a lower tax bracket, and it starts building financial literacy and real work life experience in your kids from an early age. So let's break down exactly how this works. Hiring your child is legitimate employment and the IRS allows it. As long as the work is real, the pay is reasonable, and it's properly documented. Here's the core concept. When you pay your child a salary from your business, that payment is a deductible expense for you. Your business income is going to go down, which means your tax liability goes down. And depending on your child's total income for the year, they may owe little to nothing in taxes because of the standard deduction. For 2025, the standard deduction for a single filer is over 15,000. That means a child can earn up to that amount and potentially pay zero in federal income taxes. You deduct it, they kept it. This is how your money moves through the family tax efficiently. The work has to be legitimate and age appropriate. This is not about creating a paper job. The IRS expects that the work performed is real, necessary to the business, and paid at a rate that you would reasonably pay anyone else to do the same type of work. Some examples of legitimate tasks are social media management, filing and administrative work, data entry, photography, answering phones, shipping products, or maybe it's just cleaning the office. For younger children, it might be modeling for products or just helping with those simple physical tasks at an appropriate wage. Older children can take on more substantial roles. The key documentation you need is a written job description, a timesheet or log of the hours worked, and those payroll records that are showing consistent payments. Treat it like you would treat any other employee. This is where it gets nuanced and where working with the tax strategist becomes critical because the tax advantages vary significantly based on your business structure. If your business is a sole proprietorship or a single member LLC that's taxed as a sole proprietorship and your child is under the age of 18, their wages are actually exempt from FICA taxes, meaning no Social Security and Medicare tax on those wages. That's an additional savings layer on top of the income tax benefit. If your business is an S corp or a C corp, FICA taxes do apply. That doesn't mean that, it makes the tax strategy less worthwhile, but it does change the numbers. You need to run a proper analysis to understand the full picture. This is not a one size fits all play. The structure of how you set it up directly affects how much you save. This is exactly the kind of conversation to have before you start cutting checks. Your child needs to be on payroll properly. That means they have their own W 2 at year end. That means withholding and reporting is done correctly. That means their wages are tracked just like any other employee. You cannot pay them in cash with no records. You cannot give them these lump sums without documentation. The IRS will look for consistency and legitimacy if this is ever reviewed or you go through an audit. Also worth noting, your child needs to have their own bank account. The money should go to them, not to you, not back into a joint account. Real employment means real pay that they control. Some families use a portion of the earnings to fund a Roth IRA for their child. A minor can contribute to a Roth IRA up to the amount they earn. Starting a retirement account at 12 or 14 years old with decades of compound growth ahead of them, that is legacy building in action. I want to take a moment to zoom out because this strategy is about more than just a tax deduction. When you hire your child, you are teaching them what it means to earn. You are building their financial literacy. You are putting their name on a paycheck and showing them how money works in the real world. And if you pair that with a Roth IRA, you are setting the foundation for generational wealth, starting before they even graduate from high school. Think about the conversation you were able to have with your child at 16 when they already have a growing retirement account. That is not a normal experience for most families, but it absolutely can be yours. This is what I mean when I say tax planning is more than taxes. It is about building something that will last. A few things to avoid. Do not pay your child more than the going rate for the work they are doing. Do not create a role that exists only on paper. Do not mix their wages with household money in a way that blurs the lines. And do not try to set this up retroactively in December just to get a deduction for the whole year. The employment needs to start. It needs to be documented and be paid throughout the year. If you set it up right, it's a solid, defensible strategy. If you cut corners, you are creating a problem. Work with someone who knows how to set up this structure and do it right from the beginning. Hiring your kids is one of those strategies that sounds too good to be true until you understand the mechanics. It is fully legal, it is fully legitimate, and when it is structured properly, it creates real financial benefit for your business and real opportunity for your children. If you want to know whether this makes sense for your specific business and for your family situation, let's talk. Building wealth as a business owner is a team effort, and your team can include your family. I'll see you in the next one.